Elaborate on why it was removed from the central bank. What was the logic behind that?
Yeah. So the logic
And
was,
what are the international best practices?
the logic was, Chari, now how most of the countries, almost all countries, how they service debt is borrowing from Peter and paying Paul.
Yeah.
Right. So they are basically not saving money. They are just borrowing from someone else and settling it. So they are basically rolling over debt. That's called rollover. So when you are rolling it over, you are in a better position if you roll it over at a lower financing cost. For an example, you are settling down a loan which has taken at a higher interest rate by taking another loan which is at a lower interest rate. So you, over a period of time, you bring the interest rates down. But of course, interest rate is not a function of, interest rates it's all market determined. There can be so many factors. So when the central bank was managing the debt or the debt repayments, central bank is the one who is deciding on the interest rates. So when the central bank also is servicing debt, or when they are also run the function of the debt servicing, central bank, what they do is, when they want to service the debt and when they want to achieve kind of debt sustainability, they will artificially bring the interest rates down to manage the debt situation. But when you bring the interest rates down artificially, just because of looking at the debt situation, because you are in the same institute, then you run for a balance of payment crisis. Because when the interest rates brought down artificially, then people start spending more, people swipe more credit cards, and then it adds to then you go for another forex crisis. And when you have the forex crisis, then it's a vicious cycle. Then it's, of course, when you don't have forex, then your exchange rate depreciates, and with exchange rate, you again your inflation goes up, and when your inflation goes up, you have to increase the interest rate. But you can't, then when you increase the interest rates, your debt sustainability is also in jeopardy. So as a result, they have the right thing to do is, of course, having a separate debt management office. So the central bank have their independence on managing they are mainly liable for inflation. So they are only looking at inflation and adjusting the interest rates accordingly. Of course, we have a view. There are different views. Some people think inflation target is too high. Some people think no, it's manageable.
That's a whole different topic.
But however, central bank target is inflation. So they adjust based on the inflation, they only adjust the interest rates, not only looking at the not looking at the debt side.
So the central bank essentially decides monetary policy without any consideration for debt sustainability.
Correct.
In the current model and the global best practices. What if somebody were to say, when you do it independently of that, say for example, there is growing demand, credit growth going above the level inflation, right? The central bank goes and raises policy rates, rate hike. The debt, in this scenario, if the debt is already at an unsustainable level, that just makes it more unsustainable. So are you not creating another problem there by divorcing these two?
It is not, because now you have of course there will be an implication when the interest rates goes up when on the debt situation, because when you are rolling it over, your debt, your repayment and the servicing may be more expensive. So that's the role of the public debt management office, because now they can act independently for the interest rate. Of course, the central bank cannot also increase the interest rates too much, because then it will also have an impact on the economic growth. But of course, now growth is also not their mandate. It's mainly the inflation. But then the inflation will come down further. Like when you have two very high interest rates, it will fall below their But
Dana, my point is the PDMO, the debt management office, has no say in monetary policy anymore.
Correct.
Right? Not anymore. They don't have a say. The central bank does not have to consider in any way debt sustainability in their monetary policy.
Correct.
So I'm asking, divorcing these two so absolutely, couldn't that lead to another issue of the debt sustainability getting worse and worse?
I do not see it as a risk, because ultimately, even when you weigh the pros and cons of having it together and divorcing it together, I feel the weightage on divorcing it together is quite higher, because when you have it together, you always tend to bring the interest rates down artificially. So now you anyway no central bank want to increase the interest rates too much. Like there's always a market pressure, because the moment that you increase interest rates, beyond what is required without any consideration of other factors, it is definitely, everybody knows, and the pressure from the markets will be there, because no one really wants the high interest rates. But no one will say anything when you bring the interest rates down artificially. So that system is there, and of course the central bank also, in terms of their interest rates target and their inflation target, it always a conversation, and there's a framework provided in the act itself to discuss with the Ministry of Finance. So actually, while it is divorced, these concerns may come, because ultimately there has to be a conversation, dialogue between the central bank and the Ministry of Finance.